You know how it goes. The US debt continues to expand, your currency continues to devalue, and you sit there and you take it. You came here for the truth, so let me unveil that for you. We don't have to live like this. We need to get serious first with the knowledge of why this is happening. Then we need to understand how this is going to change and then what we can actually do about it. All here in this video. If you could stand it, if you can handle the truth, let's begin. First things first, you can see, why is growth so strong? One factor has been government spending, which grew at an unsustainably 4.7% in real terms over the last year. And so we can see that this is one of the fastest rates in decades. It works at a cross purpose with monetary policy objectives. They're trying to tighten. The Federal Reserve is saying, we want quantitative tightening, but it's going the opposite way. The government is spending so much money. So we can agree upon that, right? The Federal Reserve, they're tightening what they have to do. They've increased interest rates. They have been reducing the amount that they keep on their balance sheet. Okay, that's for sure. And they've made it very clear. They want to tighten their monetary policy. But what's happening on the government side is that they're spending like never before. They've got this golden goose and it keeps laying eggs. That's you, the taxpayer. And so this is happening at the same time and they're basically counteracting each other. It's like, one's banging and one's going this way and then they're just fighting against each other and it's not working. Why is this a concern? It's very simple. If you have too much debt, you need somebody to buy that debt, and doing so will allow you to keep going further and further into debt. As long as you have a buyer for it, you can do that. But what happens when there's too much debt and there aren't enough buyers? Let's explore that now. Nobody wants US Treasury bonds. Now, of course, I wouldn't say nobody, but it's coming. The time is coming when there's not enough buyers. This is an extremely frightening scenario, not just for the US Treasury market, not just for those invested, not just for the US dollar. It's going to affect even beyond just the United States. Everybody in the world will have to feel this, and I'm going to explain this. Once a symbol of America's economic might and accepted as a global coin of the realm, they have fallen badly out of favor with serious consequences for taxpayers, investors, and financial markets. Elementary economic forces, too much supply, not enough demand, have collided to create the worst stretch of U.S. government bonds since the Civil War. Can you believe that? This just happened. Literally, that just happened. The government keeps borrowing to cover its budget deficits, while once reliable buyers of that debt, both at home and abroad, have pulled back. So the Federal Reserve was buying that all. You had the domestic consumption, you had foreign buyers, all happening at the same time. So the U.S. can get on more debt, and you have to, you basically get to reap the benefits of that. But now things have changed. The result, investors are demanding the steepest yields since 2007. Auctions of fresh bonds that were once routine are now going terribly, and bond portfolios are getting absolutely hammered. The longest dated Treasury bonds are in a bear market worse than the dot-com bust and almost as bad as 2008. So what happens is the country goes in debt, they package all this stuff up, they have these auctions. You have all these different parties that come to the auction and they say, I'll take that, I'll take that, I'll take that. They buy it all up. Usually it's oversubscribed, meaning like there was even more demand. But now that's not happening. And so that starts to lead to a crisis because there's a recognition of that. And think about this. You don't have enough buyers. Let's say you're offering 5% on that particular bond. Well, you'll always have a buyer. But at what price? So that's what's going on here. Oh, we're not going to do it at 5%. We'll do it at 5.1. Do I hear 5.2? Do I have a 5.3? Do I hear a 5.4? You understand the auctions? Like that's kind of the thing that's happening right now. And so we have a big concern. Like there's not enough attention on what's happening. It is extremely important. We're like on the cusp of this. here. Grizzly bear, how the bond route stacks up to past bear markets. And you could see it is very aggressive. There's no question about that. And so it leads me just into this, which essentially highlights the government borrowing more than expected, increasing the supply of treasuries, dinging their value. The Fed is selling down its own holdings, dumping yet more bonds into a market that doesn't really want them. We have been warned, like I know I have been warning about this for a long time, that nobody wants this garbage. Okay? And it's a simple matter of fact. Mortgage-backed securities, especially, but you know it's all temporary because they're going to come back into the market. They're going to buy it all up, and they always buy more than they did in the previous cycle. What happens as a result of that? Oh, no. Oh, dear. There's just a lot less demand than there was even 6 months ago. You can buy a 6-month T-bill that's yielding north of 5%. Why wouldn't you buy that instead of a long bond that's yielding 4 3/4? You see what's happening here? The numbers are all mixed up. The longer dated, you should get better return, but that's not happening right now, and that's why everything's all screwed up. Okay, and so basically what they're saying is, look, they've got this spending that's happening from the government. Is for one reason or another. They're doing the infrastructure, they're doing this and that. They're spending too much money, and guess what? You enter a recession. What's the very next thing that happens? What is it? The government's got to spend more. They got to do stimulus checks. They got to support this. Oh, the car industry's failing. Here's some money. Oh, that industry's failing. Here we go. Oh, you want to write off the student debt? Here you go. That's all fine and dandy if you've got a buyer for your debt. But that doesn't happen when you're in these circumstances. The Federal Reserve is going to have to reverse all of their policies and give it a go. They're going to take gasoline. You know that gasoline, you go and fill up your car and you say, oh my God, the price is unbelievable. Yeah, well, that gasoline, imagine you see a big like tire fire. Like you just see this big fire. Oh my goodness, there's a fire there. You know what? I know what I'm going to do. I'm going to pour a whole bunch of that gasoline that cost me an arm and a leg. I'm going to pour it in that tire fire because that's going to fix the problem. That's going to make the fire go out, right? And that's a silly analogy, but that's not really a silly analogy. You can call it a dumpster fire. You can call it whatever you want. It's a mess. And I hope you see the progression of all these things. I have literally been talking about this since let's just say, since I have it documented, since January 2012 in my first book. It's unbelievable to see it unfolding before my very eyes. Bill Ackman is literally moving bond markets. On October 23rd, Ackman posted that he had covered a bond short that he took in 2023. The market, it was the exact peak. And then, of course, he said in Q1 2024, the Fed is going to cut rates. We will see. But he predicted that, there's no question, right on the money. Right on the money. Coincidence, possibly. Who knows? We don't know what these guys, what their MO is, but this is the world we live in. Interesting, I would say. The US dollar is barreling towards a 3.7% loss this month against the basket of 6 major currencies and will be the worst monthly performance in a year. So generally what happens, not in all cases, generally what happens is you have the stock market working inversely with the US dollar. So remember, we had the US dollar strengthening on and on and on, but the stock market was coming out, or at least it was quite weak. Now that trend is reversing. Gold performing well. But what I need to note here is it's not bad, for somebody who earns US dollars but doesn't live in the US. A strong US dollar is quite a thing. It's a nice thing. But when it starts to reverse, it's like, oh dear, But the US dollar still reigns supreme, let's be honest. But just understand what's happening. It's against a basket of other currencies. At the same time, measured against real goods, let's be honest, they're all losing out. And we lose out. Falling bond yields help make another Fed rate hike likely next month, but expect a quick pivot to cuts in 2024. That's according to S&P Global. I don't know, honestly. Are they going to increase interest rates and then cut immediately after? What do you think? Or are they just going to, that was the last one. That's it. It's done. All done. You tell me. I want to know in the comments. Let's talk about that. And this is just the reason I put this here was to talk about what the end result of this. You got to understand. There's too much debt if there's a recession or if there isn't a recession, they're going to spend at least a lot of money, maybe an extremely large amount of money, but you know it's going to be a lot, whether it's for the infrastructure projects or whatever. They're going to spend more money. When they do that, they need to have the buyers of that debt. If they don't have those buyers, the Federal Reserve says, whoa, hold your horses right now. We were doing a QT. Now we got to do at least a backdoor quantitative easing. So the message is very simple. Let's go in there. Let's print that money. Let's buy it all up. At the end of the day, they're going to create more inflation. That means the prices of everything that you pay are going to be higher than what they are today. Knowing that information, if you knew your groceries, if you knew your water, your electricity, your cars, your everything, if you knew that was going to be more expensive in the next year, what would you do? What are the actions you would take? And start to do that. Get the pen, get the paper out, and start to think about that. The next time you're waiting at the bus stop or you're sitting in traffic, just take a moment, turn the radio off. I do this all the time. Turn the music off. Don't have those distractions, and just go through and just think of it and like a workflow, like a chart, and go through and think, okay, if that happens, then what could happen? And then you start to think of all the different possibilities. And you need to do that for your own good, for your family, your neighbors, the people that are quite frankly going to rely on you. Because what's happening here is unlike anything we've experienced. Imagine the level of inflation we got from 2020 into 2022. Pretty bad, right? Well, it always gets worse. The actions that they take are always even greater than the previous instance. They do more. They create more inflation. So think about it. We're at least at bare minimum, base case, what we experienced from 2020 into 2022. That was terrible. Expect that again. What if it's double? What if it's triple? These things could happen. So plan accordingly. Take the actions that you can today. I hope that you will, share information you can that you find valuable with your friends and family. Even sometimes if they don't want to hear it, give them just a little tidbit. Knowing that, maybe they start to, come to terms with it, but at least you can have no guilt on your conscience. Say, hey, I tried. That's the way it works. That's why I make these videos, to help those who are willing to listen. I hope that you will give me a thumbs up on the way out because it supports this channel. But what you're doing is basically notifying some people who might be on the fringe to say, hey, what's this all about? I thank you for that. And as always, I want to see you here tomorrow. Take care.